We thought it was really, really important to have a panel discussion discussing one of the central issues of our age, which is climate change. Originally, the plan was that Per Crusell and Bob were going to be the panelists. And oh. Okay, is this better? Is this better? Can you hear me? Okay, good. Anyway, originally Per Crusell and Bob were supposed to be on the panel, and I was supposed to serve as timekeeper. And Per suffered what Richard Rogerson would describe a Minnesota shock. He had a family reunion, which was arranged a year ago to occur today. And so he was unable to make it to the panel. So we restyled it as a conversation. But it's really going to be me asking Bob a bunch of questions after his presentation. And then we'll try and keep that relatively short so that all of you can join in and participate. So I thought that before we get Bob's presentation going, I would try and set the stage for the economics of climate change, partly because not all of you might be familiar with what has been done and what people are doing. At a conceptual level, this is a pretty straightforward problem. You have the natural scientists telling us something about what the consequences of, say, the emission of greenhouse gases is going to be on various aspects of the climate. And then you want to have economists telling you what the effects of the climate are going to be on economic outcomes and how economic outcomes determine the emission of fossil fuel and determine the emission of greenhouse gases. That naturally suggests writing down models where you have a natural science module, which is going to tell you something from the natural sciences, and an economics module that's going to say something about that. Bill Nordhaus was really, was among the first, in many ways the most influential person to start working on this model. Nordhaus is a very well-trained neoclassical macroeconomist. So he set up the problem, because he had to abstract from a whole bunch of detail, in the way my guess is the vast majority of you would have set up the problem. So what he did was he had to write down something about the natural science module, and he had to condense the natural science module into some low-dimensional statistics so he could actually do something with it. And following suggestions from the natural scientist, he decided that the main aspect of the natural science module that he was going to focus on was temperature. Then he had to figure out how does temperature affect economic activity. And he did, as a first cut, I think what would now be completely obvious to all of you, he said, I'm just going to model the effect of temperature as an effect on total factor productivity. So total factor productivity is some function of temperature, and then temperature is determined by the emission of greenhouse gases, and economic activity determines the emission of greenhouse gases. That, as a first cut, was pretty darn useful. What he wanted to use this model for, was to answer kind of obvious kinds of questions, which are what sorts of Pigouvian taxes would move you to, say, the Pareto frontier, in the intergenerational, in particular, Pareto frontier. And he put numbers into his model based upon best guesses and came up with a variety of estimates. Because his model was dynamic, you ended up not with a single number on the Pigouvian tax, but rather a whole schedule of numbers. And that whole schedule in the latest incarnations of those kinds of models ranges from roughly about $30 per metric ton today to something like $150 a metric ton, rising to $150 a metric ton roughly a century from now. So just so that it's hard to understand, what do you mean $30 per metric ton? Think about that as 30 cents, a 30-cent tax per gallon of gasoline, right? Okay, so we're talking about important changes worldwide, but hardly earth-shattering. Subsequent research that has evolved since then has attempted to refine both the natural science module as well as the economics module, but has retained the basic conceptual structure, which I think makes sense to me, and I suspect to most of you, how you should think about that. So one of the leaders in developing the next generation of models is Bob Litterman. For those of you who don't know Bob very well, Bob, of course, is one of the most distinguished alums of the University of Minnesota and an exemplar of the partnership with the Federal Reserve Bank of Minneapolis. Larry Cristiano knows this. Bob was one of the central developers of what's called RATS, Regression Analysis and Time Series, which was a software program which had basically 100% market share on time series analysis until Bob got bored with it and moved on to other things in collaboration with Chris Sims and Tom Doan. So that was really important. He was an academic superstar. His first job was at MIT. Not a shabby place, he thought, when he went there. He went there, found out how shabby it was, and quickly returned to the Federal Reserve Bank of Minneapolis. Then something happened which Bob Lucas has often described to me as an example of, we're going to talk about climate change, big divergences between what is privately optimal and what is socially optimal. So Bob had already established his academic chops. For those of you who don't know this, I'd strongly recommend you go back and read a classic paper in empirical macroeconomics by Bob Litterman and Larry Weiss, I think published in Econometrica. It's a beautiful paper after all these years. But the divergence between private and social optimality happened because Goldman Sachs made him an offer he could not refuse, even though any benevolent social planner would. I'm looking at you, Art. Any benevolent social planner would have made sure that didn't happen. In any case, his first love is still academic economics. So after he left Goldman Sachs, he's been engaged in a huge range of activities. Bob's day has 27 hours in it, I think, 27 working hours, I think, because he does lots of different things. Among the important things he's been working on with Kent Daniel and Gernot Wagner and a bunch of other people is to develop the next generation of climate change models. With all that, why don't we have Bob tell us a little bit about the next generation?
All right, well, thank you so much. I think I'm just glad there's not a benevolent social planner. Let's just leave it at that. So I did bring a few slides for the panel. It's my first time being only one person on a panel, but and I've tried to sort of frame this in terms of the theme of the conference, research and policy. So let's start first with the research. And it's really, Chari has done a nice job of summarizing it, but greenhouse gas emissions create temperature rise and potentially some negative impacts on future well-being. So that's kind of well understood. It's been understood for over 100 years. it seems kind of obvious that to an economist that the solution is to price this risk. That is to create appropriate incentives to reduce the emissions. And in fact, I got interested in this when one of my partners said, Bob, are you interested in environmental issues? I said, well, not really, but I could be. And I said, I've been thinking about climate change, and it's kind of obvious that we need to price this, and we're not doing so. And my partner said, well, Bob, that's kind of obvious for an economist. The problem is no one knows where to price the risk. And I thought, that doesn't seem right. And I've been working on risk problems for a while and some economics, so let me read the literature. And so I started reading it. And as Chari described, the main models were developed by Bill Nordhaus, and they used kind of economics that was, well, he started 30 years ago, and so the economics kind of predated modern understanding of asset pricing. And so if you read the literature, and in fact, if you listen to the kind of discussions that often take place in terms of policy analysis, even though economists know better, they will say things like, well, the price is very sensitive to the discount rate, okay? But we don't really know what the right discount rate is. And in his early work, Nordhaus kind of said, well, the discount, these damages in the future are highly uncertain, so they're risky, so we should use a risky discount rate like the equity discount rate, so it's a high rate, and these damages are far in the future, and so a very low price makes sense today, kind of rising slowly over time, and people talk about that as being the policy ramp, the increasing price over time. Well, of course, when you start taking uncertainty into account, it's a risk pricing problem, which is to say it's an asset pricing problem. And so we know a lot about asset pricing. You don't get to pick the discount rate. I remember at Goldman, I used to price mortgages, and we would talk about the yield on a mortgage, but it wasn't that you picked the yield, you solved for the price of the mortgage, and then you could always go back and say what fixed yield, if you discounted all the cash flows, would give you that price. But it's an output, it's not an input to the model, and that's basically the same problem here. Emissions create random cash flows in the future, that is damages, you can call them negative cash flows. The marginal utilities in different states of nature impact the discount rate, and worst case outcomes get more weight. Now let me say just a little bit about worst case outcomes. At Goldman, they made me head of risk management at some point. And your job as a risk manager is to worry about worst case. That's what senior management always used to ask me, what's the worst case? They didn't like my answer, of course, which was no one knows, I can't tell you. They asked me to look at the swap book one time and said, how much could we lose? They definitely didn't like my answer, which at that point said, well, you have to look at the covariance between defaults and market moves, and it could be just about anything. And that wasn't a good answer. So we came up with, by the way, value at risk. You may have heard of value at risk, which is a probabilistic answer to that. Not a very good answer, but it tells you. Anyway, in the case of climate, this gets a little bit more interesting because Nordhaus, among others, realized that, well, yeah, it actually does depend on covariances. So there's a usual analogy made between climate damages and recessions. And so the question is, do the damages occur more in bad states of nature or good states of nature? And Bill argued that, well, if we have strong economic growth over the next 50 years, we're going to have a lot more pollution, a lot more damages. If we have poor economic growth, we're going to have lower pollution, lower damages. And indeed, during the Great Recession, we saw a dramatic drop in pollution. So, the basic story kind of makes sense. And then the basic conclusion is, well, pollution is basically a hedge against economic growth, and therefore you should actually have a lower price on emissions when you take risk into account. And now I often joke that only an economist could think that way, but the reality is that as long as the damages from climate change are small, relative to the uncertainty about economic growth, that argument kind of makes sense. And so what it really says is you should focus on worst case scenarios, scenarios where the climate damages can actually be larger than the uncertainty about economic growth. And clearly the uncertainty about economic growth is quite large. So we're really talking about what I would say are worst case scenarios. And where do you want to price those? And we really have very little data or understanding of what the worst case scenarios are. Obviously, this is the first time, in some sense, that we're performing this experiment. Although some people will point to, historically, there have been dramatic changes in the amount of greenhouse gases in the atmosphere and sea level, for instance, and heat. And so there are times when you had tropical environments at the poles. The difference, of course, is you didn't have 7 billion humans on the planet, and you didn't have these kind of changes happening over very short periods of time relative to the time allowed for evolution of the environment and species and so on. So one problem is you got to think about it as an asset pricing problem and think about different states of nature in the future and how bad could it be, of which we have very little data. In fact, one of the classic papers here by Marty Weitzman, when he looked at it, he developed something that was referred to as the dismal theorem, and he kind of pointed out that it's really critical what happens in the tails. As you go further out in the tails, which gets smaller faster, basically, do the damages increase faster than the probabilities go down? And so since we know virtually nothing about that, he said you can't really put an upper bound on the price. Now, that kind of, I think, goes a little bit too far, but it kind of does point to the fact that it's very uncertain and it's very delicately a function of what happens in tails about which we know very little. Second thing that I found very unfortunate about this literature was that although it's clearly a problem that has a long horizon, these models were really not optimal control models. The policies that were looked at were, where do you set the price today, and at what rate does it increase over time? And increase forever, by the way. If you want to look out, so they would pick typically an increasing rate of 3% or 4% per year and just forever. Well, that doesn't really make much sense either, as you can imagine. For two reasons. One is, there's going to be dynamics to the economy, and you want to take that into account. And number two, that there's uncertainty, new information, and you want to react to that. So it's really a dynamic optimal control problem, and one where the future states are going to be very uncertain. So, and my final bullet point here, uncertainties abound in terms of damages, in terms of the way the economy reacts, in terms of just almost everything about this problem. We only have one observation. It's just starting, so we have very little idea where it's going. So what is the right price for emissions? That's really kind of, in some sense, for me anyway, that was the critical question. If the question is, how significant is this problem, you can kind of summarize it in terms of, well, where should we be pricing emissions? And so I have done some work on this, as Chari mentioned, with Kent Daniel and Gernot Wagner, and we came up with a model. And the critical thing about our model, which is kind of illustrated in that lower right-hand corner, I don't know if you can see it, is we use kind of a tree structure, something that in financial markets we're very familiar with for pricing options, to think about, what is going on in the future and how do we react to it. And so we use the same idea. Now, in that tree, the uncertainty is a variable that reflects the fragility of the environment. So we assume you get a certain temperature, and then depending on the fragility of the environment, you get different damages. So we kind of use that to then say, okay, how would the price evolve over time, and what would be an optimal policy today? There is a huge amount of uncertainty. I've just kind of drawn some curves here to represent a range of possible outcomes that you could get, but I would be the first to admit that what we develop is really a very simple model designed more to understand what's important and what does this price depend on than to say we can pin down a number. But the UN in a report a couple of years ago said one of the problems with these models of pricing emissions is you can get answers anywhere from $2 to $200. So I think we've narrowed it down a little bit, at least in my mind. So maybe $40 at the low end, maybe 140 or something at the high end. Still very unsatisfactory, and I'm sure we'll do better over time. But also, and while these prices in our model increase for some period of time, they come down over time because we basically, very simply, we develop technology. We assume it's going to be cheaper to remove CO2 in the future, and we assume, and in our model, we basically solve this problem. Although I would point out that the time scale, if you can't read it there, is from basically 2020 to 2200. So that's a long period of time. And one other thing I would say is that what's particularly important, I would argue, in terms of putting an upper bound on the price, is the cost of pulling carbon dioxide directly out of the atmosphere at scale. If we can pull it out for $100 a ton, you're not going to charge someone $120 a ton to put it in the atmosphere. So that gives you an upper bound, although we don't know what that price of pulling carbon dioxide out at scale is. We're getting better data, and 10 years ago, the estimates I got were somewhere between $100 a ton and $500 a ton. And today, experts in this area say probably it'll be between $50 and $100 a ton. So, if it's going to be $50 a ton, I don't really think that's true. But if it were true, then that would say you don't really want to charge that much for putting it in. And as Chari pointed out, at $50 a ton, you're talking about 50 cents a gallon on gasoline. So it's not really something that's going to have a huge impact on people's utility. Now, that's today. And but the big problem is we're not doing that. And so what I want to focus on is something that came out of our model and was really very surprising to me. And so I want to focus on it. And this is what I'll call the urgency of pricing carbon. So basically what these two graphs represent, on the top graph, what you're seeing, and I'm sure very few people can see this, but you can kind of see the curves, hopefully, and the shape. The bottom axis there is time, and this is now from 1900 to 2100. If you can see what's shaded, that's history, and then beyond that is the future. And the different curves represent creating an optimal policy at different points in time. So the yellow curve, if you can see that, would be if we started pricing carbon, I think that's 1980, is it? Yeah, 1980. And then the next line is 1990, 2000, 2010, 2020. So where we are today is essentially the orange curve, which is the second from the top. It's too late to follow optimal policies historically. The only thing we can do is start now and follow an optimal policy in the future. And what the upper graph represents is the stock of greenhouse gases in the atmosphere, actually the excess greenhouse gases. So, people historically, meaning, let's say in recent times, last thousands of years, there's been about 280 parts per million of CO2 in the atmosphere, and the global temperature was basically in equilibrium. And so going on the vertical scale there, in 1900, we had already created maybe 20 extra parts per million. Today, there's about 415 parts per million of CO2, so that curve has been going up. If any of you have heard of the Keeling curve, which is just the historical amount of CO2 in the atmosphere, this is just the Keeling curve brought down, rebased at zero, so it's the excess CO2. And you can see how it's been moving up. And last year, it actually increased slightly faster than it's ever increased before, which is about 3 parts per million. And now, if we price emissions immediately, that doesn't immediately get you to net zero emissions, of course. It takes about 30 years to get there. And a lot of people are talking about, we need to get to net zero by 2050, and indeed, in our model, that's about what happens. You price emissions immediately, and over time, you reduce those emissions. So your CO2 in the atmosphere, which is the stock of greenhouse gases, peaks around 2050, and that's when you have the most impact on warming. So warming is kind of the maximum, although as you heat up the planet, you also have radiation leaving the planet, so you end up hitting equilibrium maybe 20 years after that, and that's the bottom graph. So what the bottom graph is the temperature that we would expect to happen. And so where we are today, again on the right where the blue meets the white, is about 1 degree C of warming that we've seen historically. And then the warming will continue no matter what we do. I mean, no matter what we do, but it's expected to continue until about 2070 or 2080 when it peaks. And if we were to start immediately, that peak would be about 1.8 degrees C. Okay, now, the UN has talked about, scientists for a long time have talked about 2 degrees C as being the safe level. Scientists are now not so sure that's safe. Who knows what safe means, again. And so there's sometimes talk about trying to get to 1.5 degrees, but most scientists think that's, and I would say most economists probably think that's impossible. We've blown through 1.5. Today, I think we're at about 1.8. And here's, to me, the scary thing. Every 3 years that we delay is another 1/10 of a degree. So the IPCC just issued a report talking about the difference between a 1.5 degree world and a 2 degree world. And just as an example, they said, well, we estimate that at 1.5 degrees, we're going to lose 70 to 90% of coral reefs globally. At 2 degrees, we're going to lose greater than 99% of coral reefs. So that's a difference of, half a degree, which is to say 15 years. And obviously,
these are all global prices, right?
This is the model that this relies on is a globally harmonized price. And now I would qualify this in an important way right now. I think of this maximum temperature as kind of a sufficient statistic for the risk of negative impacts on human well-being. But there are actually fairly inexpensive ways to reduce global temperature by shooting particles into the stratosphere. And so we can cool the planet. And so in my mind, we're not going to see 1.5 or 2 degrees C. At some point, governments are going to figure out that's a very dangerous thing to do, and let's cool it down. But it doesn't change all the impacts. You also have acidification of the ocean. That won't affect that. You also have changes in weather and other impacts. So you can't recreate the environment that we have today. You're just trying to fix it. And then if you stop shooting particles into the atmosphere, for example, and you continue to emit emissions, then that would create a dramatic warming immediately. So you're kind of committing to geoengineering the planet for a long time. But again, I would say I don't want to overstate the danger, but there's just a lot of risk here, a lot of uncertainty, and it's increasing at a dramatic rate. This is something that we should have done. And if you look at those, say the yellow curve, or even the green curve there, if we had started 20 years ago, this would be a much smaller problem than it is today. And I think just in terms of psychology, most people think, well, how bad could it be? We didn't do anything for 20 years, and we're doing fine. We're just starting to see impacts. Well, that's not the case. The case is that the damages are increasing at a much more or the expected damages, let's put it this way, are increasing much more per unit of time today than they were 20 years ago. And recognize that 20 years ago, the idea is if we had followed an optimal policy then, again, another, I think, psychological crutch that a lot of us have is that, well, especially given this historical focus on a slowly rising curve of pricing, well, if we don't get started immediately, we can make up for it in the future. Actually, it's not that easy to make up for it in the future. And in our model, we can actually translate that change in when we start pricing into a cost of delay. What's the deadweight loss in this model created by delay in pricing carbon? And it really kind of explodes. So if there's a 1-year delay, it's not that bad. It's about $700 billion, which is, it's not insignificant, obviously, 2% of annual global consumption. But a 5-year delay is a $17 trillion loss, which is to say half of annual global consumption. And a 10-year delay is 70 trillion. So it's basically rising quadratically with time. And so I would say, yes, this is a very urgent problem and something that we really want to focus on. And now I want to turn to the investment implications. You know, I've spent a career on Wall Street, so of course I asked, well, what does this mean for investors? And actually I was at the World Wildlife Fund, I'm on their board, and run their investment committee. And so a lot of our directors were very concerned about this and said, what should we do? And about 6 years ago, you know, they said, why don't we divest of fossil fuels? And so we had a consultant, Cambridge, came in and they looked at our portfolio and they said, well, gee, guys, you have less than 1% in fossil fuels, you know, and it's in private equity, it's in hedge funds, it's in your equities. This is going to be a huge effort to try and get it out of your portfolio. It's going to cost you a lot of money. Why don't you just ignore it? Well, actually, they said you have one natural resource fund where, you know, half of it is located. Why don't you sell that? And then don't worry about the rest. And we said, well, that's not going to be good enough for us, frankly, for reasons more having to do with reputation than risk of loss. But we figured, you know, people are going to focus on what did you do and does it make sense? And so we said, can you come up with something better? And they came up with something I thought was terrific. We gave it a name. We called it a stranded assets total return swap. So it's a derivative instrument. It doesn't affect the underlying portfolio, but it basically allows us to sell our fossil fuels through an overlay. And I liked it for a couple of reasons. First of all, it's very cheap, doesn't cost hardly anything. It's basically a bet. We did it with Deutsche Bank. They don't have a great name now, but they were, let's just say at the time, it seemed like a reasonable counterparty. And so we basically make a bet with them. We say, look, we will pay you the total return on a basket of stranded assets, and you give us the total return on the market. And so they agreed to that, and we debated whether we should sell actually what we owned or just a basket to hedge the risk. We decided we'll just sell a basket. So we took market cap weights in the top coal stocks and in the top oil sands stocks and entered into that. And then this is the total return on that stranded asset swap. As you can see at the beginning, didn't do much, but then, and I'm sure you can't read this, but I've highlighted some events. So for instance, in August 27th, we put this on in January of 2014. That summer, David Swenson, who is one of the most respected investors out there, he's been running the Yale Endowment for a long time. They've had terrific returns. He sent a letter to his external managers and said, we want you to take climate change into account in all the decisions you make. And right after that, you can see the total return on this swap was quite dramatic. Right around the end of 2015, my wife Mary said, Bob, why aren't we invested in this, for obvious reasons? And it turned out Goldman Sachs was happy to enter into that. One of the questions I often get is, why would a counterparty take the other side of this bet? And the answer is, well, they're not taking it. They have a derivatives book, and this is a position. They then hedge it. So a better way to think about it is they're just executing on your behalf. You're executing with the market. A lot of people think about divestment as a moral decision. Let me just say, this is a totally economic decision. You can talk about it as hedging risk, or you can talk about it as, you know, you think it's a good bet, and I'm doing it for the money. And in any case, I would highlight that after it kind of peaked right after the Paris Agreement. So I think there was a lot of optimism before the Paris Agreement. I think after the Paris Agreement, investors kind of realized this isn't going to really do anything. And so there was, it was pretty flat for a long period of time. In fact, it declined quite significantly right before the last presidential election. But as you can see there at the end, for the last year, it's been doing quite well. And I would say, as I say maybe this reflects increasing expectations of emissions pricing. Bottom line, though, is stranded assets have dramatically underperformed. As of today, actually, this total return swap is over 100% return over that 5 years, so more than 13% annually. We have, and I should say, though, we have adjusted the weights a little bit. So it started out mostly coal and tar sands. We've now added oil exploration and production to it, and we do readjust it over time. And I would also point out that it was just market cap weights, and there's no reason to make it market cap weights if you have a theory about which oil companies, for instance, are more exposed to pricing of emissions and which are less. And when I say pricing of emissions, something else that people get confused about is actually the oil companies themselves, the only emissions they create, of course, are in their refining operations, which is a small cost to them if you were to price emissions. The real issue is if you price emissions globally, you're going to have less demand for oil. Less demand for oil is going to lower the price of oil. And so it's really how are they exposed, which oil companies are most exposed to a lower price for oil. This is definitely sort of playing out if you've been following the story about Saudi Arabia doing an IPO. If you're Saudi Arabia, they have 80 years supply of oil at current production rates. And there's a lot of talk about what drives their policy. I have no particular insight into that. But as an economist, you'd say if you have a reservoir of oil and you want to maximize the net present value and you realize that there's going to be less demand, what are you going to do? You're going to produce more today. You're going to take market share. Now, if you've been watching OPEC and Saudi Arabia's policy, it's been to produce less oil. So you might say, well, obviously that doesn't make sense. They must not be worried about that. But at the same time, they're trying to sell the whole thing through an IPO. So what you might do if you were a little bit clever is you'd say, well, let's keep the price up now, sell this whole reservoir, and then, maximize the value that way. So I would say, yeah, kind of makes sense what their policy is doing. And I think they do understand that there is going to be dramatically lower demand for oil in the future. Now, turning to policy, I've been kind of working on getting carbon emissions priced for a while. It's a global problem for sure. There's a number of important frictions associated with pricing carbon. And one of them is just the global cooperation problem. There's a free rider issue here. If China, and you often hear this in the debate, it's not going to do anything for the U.S. to price carbon if China doesn't price it and India doesn't price it, and it won't have any impact. And that's basically true. It's got to be done globally. I would argue China's already agreed and designed a national emissions pricing scheme. Europe did it years ago, but these schemes right now are at very low levels, so they haven't been very effective. Although the European Union actually price, which was at about $5 a ton for a long time, has recently gone up to $30 a ton. So it's starting to have an impact. And I'm on the board of something called the Climate Leadership Council, which is a group that has developed something called the Baker-Schultz Carbon Dividend Plan. This is Jim Baker and George Shultz, two elder statesmen of the Republican Party. Really, I think many people have felt, and I have for a long time, that if you want to have a successful legislation, it's got to be bipartisan. And it was the Republican Party that was not supporting this. And so I've been trying to support anything on the Republican side that would support pricing of carbon. And this group, the Climate Leadership Council, had a lot of success early on. We call it a carbon dividend plan for obvious reasons. People don't like tax, but the idea here is that we would tax carbon, we would take the revenues and distribute it on a per capita basis. Now, most economists would not think that distributing it on a per capita basis is the best way to do it, but that's really something about, fiscal policy has nothing to do with climate, but from political point of view, giving a dividend is actually a very progressive tax. May not be the optimal tax, but 70% of the public would actually be better off, and it would be those who don't use as much energy, and so basically poor people. And there's a bordered carbon adjustment, which would say if you're importing goods from a country that is not pricing emissions, then you should tax that. That creates an incentive for countries that are not pricing carbon to actually institute a carbon tax so that they collect those revenues rather than we would on a border adjustment. And there is a regulatory simplification, which is to say, let's get rid of ineffective regulations, such as, for instance, the auto emission, what do they call it, CAFE standards on more efficient cars, which is a very expensive way to reduce emissions. You make the car much more expensive, and then there's no marginal incentive to reduce the amount that you drive. So this would just create the right incentives. As I mentioned, there's issues, very significant issues about international coordination and governance. Another thing that I've been working on is the aviation industry, and I'll just mention that very quickly. Aviation is kind of an interesting sector of the economy because it does create a lot of emissions. For most individuals that fly, like myself, that's the biggest part of my carbon footprint, is that I fly a lot. And aviation has been trying since day one to reduce its fuel use. That's the biggest marginal cost for aviation. So they have increased the efficiency of their aircraft, but the rate of increase in efficiency today is about 0.25% per year because they've done everything that they can. And they have a very strong governance structure globally. Something called ICAO, the International Civil Aviation Organization, is able to regulate all airlines. So if you're a Russian airline and you're flying to New York and you don't particularly want to price emissions, if ICAO says we're going to price emissions, you're going to pay that tax. So it's an area where we could have strong international coordination. And I've been working with another economist, Niven Winchester, from MIT, to come up with a plan to create a trading scheme within aviation that would set a globally harmonized price on emissions, which would be in aviation's interest, because if you think about it, 20 or 30 years from now, when ground-based emissions are essentially zero, aviation emissions are going to have grown to be about 70% of the remaining emissions. And so the atmosphere's capacity to absorb emissions is a scarce resource that they need. So they have an incentive to create a global benchmark for emissions pricing that could then hopefully provide a standard that other countries could kind of migrate to. So anyway, I'll stop there, but happy to take questions.
So we'll have questions in just a minute. I wanted to make one sort of technically oriented remark to those of us who are nerds, which means all of us, which is one thing that I found fascinating, Bob, in your model is how large the cost of delay is. For those of us who grew up reading Dixit and Pendike and the other investment literature, in environments where all you're waiting for is new information, in those kinds of environments, it's often very beneficial to delay. Right? This is the classic kind of situation is, suppose you're just indifferent between investing at a particular scale in an environment where prices are going to be constant. Now let's suppose that prices could be $1 higher or $1 lower. And it's a reversal investment. What do you want to do in that kind of situation? You want to wait for, say, that one period If the prices happen to have been higher, you haven't lost very much. You just lost one period of profits. If the prices happen to be $1 lower, then you've saved all of your investment. So there's normally in those kinds of environments a very substantial incentive to delay. Here, because of the fact that the technology dictates that the longer you wait, the worse things get, there's a very substantial cost of delay. I just wanted to point that out because the cost of delay is going to be a puzzle only for macroeconomists who've thought about investment behavior. And that includes many of you here. So that's why I wanted to mention that we've got only a limited time. So I was going to pose a whole bunch of questions to Bob, but we can do that on our own. Why don't we throw it open to all of you? If you don't have any questions, I'm happy to.
What do we know about how sensitive emissions are to carbon prices?
Well, we don't know a lot because we haven't really raised the carbon price to a significant degree. We have very low incentives in most of the world. And frankly, it's worse than that because if you think a little bit more broadly, there have been very significant subsidies to fossil fuel production and consumption globally that have by far dominated the very weak incentives that we have created to reduce emissions. So for instance, it's not that expensive in the context of a coal-fired power plant to pull the CO2 out of the flue gases. We know how to do that, but there's just no incentive to do it, so no one does it. So we haven't developed that technology. And going for, 10 years ago, that would have been a very significant thing to do. But today, we're burning a lot less coal, at least in the US. And so that's not really a significant aspect of the problem. But I would argue that indeed, going back to what you were saying, Chari, we would learn a lot by pricing carbon and seeing, what actually is the cost of pulling it out and how responsive is it, how elastic is that going to be? We don't really have much data on that.
Can I just say one thing about that? There's an analogous situation where the evidence is particularly dramatic, which is in the 80s, acid rain was a huge problem. A lot of it created by sulfur emissions from utility companies. And under the first Bush administration, we instituted a market for trading rights. Prior to the institution of that market, engineers of various kinds were surveyed about what they thought the marginal cost of reducing sulfur dioxide emissions, a ton of sulfur dioxide emissions. They came up with numbers. Median number was $1,000 a ton. We set up the market. People started trading this stuff. We found it was roughly $50, $60 a ton. Right, okay. So once people are confronted with a market price, I think we all understand this. Lots of other people don't. People seem to come up with extraordinarily clever, ingenious ways of doing things that the engineers themselves, you ask them, can you do this? Oh, no, I can't. Okay, the price is going to be $60 a ton. Well, let me think about it. I think I figured it out. Anyway, there were several questions. Fabrizio.
But my question is, it says pricing an asset, but you're pricing an asset in a world of incomplete markets and a lot of inequality. So the key issue, and if you think about the current political climate, why it's so hard, why we pull out of the stock agreement, is a lot of people that don't want to pay the thing. So I really like the idea of rebating lump sum, but I'm just thinking maybe it's not enough, and we should think about how to convince, and this is not just in the US, even globally, poor countries to go along with the plan, because of course, talking about something.
Right, whenever I talk about this in a global context, the first question I get is, well, you can't expect, I don't know, Pakistan or Bangladesh to price carbon at the same price as the US, and I'm an economist. I just say, look, it's one global. Every ton is going to have the same impact globally. If you want to worry about income inequality, I'm happy to talk about that. But that's a different problem. And what we should be doing for poor countries is providing, technology, food, housing, whatever. Wealth transfers is fine, but not subsidizing pollution. And usually people understand that. So that's my answer to that. You just got to. And the other answer is, yes, income inequality is an important problem, but it's going to take decades, if not more, to address that problem, and we've got an urgent risk management problem that we have to address immediately. So, but it's a very good question, because if you ask why the UN has not been able to make progress on this, it's because the UN was really set up and in a lot of ways is designed to address income inequality. It's not designed to address urgent, pricing problems like this. In fact, the Paris Agreement says basically nothing about pricing emissions, which is kind of unbelievable, but that's where we're at.
Fernando and Neil?
Is it possible, and maybe the question, maybe you think whether it's desirable or not, either directly or maybe indirectly through some sort of trade, to price an asset whose dividends will be proportional to the emission taxes? Because that way you will get an idea of maybe with the price before and price after, the difference, maybe with exposure. I don't know if there's a way to do it indirectly. You could imagine a contract that does it directly.
Yeah.
That will give you kind of ideas of market prices. You could also imagine the firms that you're saying trying to get the exposure anyway. You are the one that knows, so why am I talking?
Well, you can certainly, there's plenty of ways to try and use market information to learn about some of the parameters of this problem. The one that's usually talked about is things like sea level rise. You can you can design a contract as a function of sea level rise in 2050 or in 2080, and we could trade those, and that would probably reveal something about expectations. And there actually are some contracts along those lines, but of course they're very small markets. They don't have a lot of liquidity, so how much you trust those relative to, say, the best science that you can find, I don't know. But that is one of the big issues here, is we have very little information about future damages, about expectations of prices, and so on. But going back to Chari's point, I think it's a very good one. When you ask scientists what they think the price is required to get the kind of declines in emissions that we need, you get numbers like $1,000 a ton. I saw one the other day, $5,000 a ton. I mean, these are just crazy. But most economists are much more optimistic. And again, I would just focus on, well, what does it cost at scale to remove this stuff from the atmosphere? It's not that expensive, although, there's a lot of uncertainty even there.
Neil and then Randy.
So I was wondering, it seems like you could reverse this problem and think of implementing the optimal policy through a subsidy. And given low interest rates on government debt, and given that people don't seem to have an aversion to financing things through deficit financing, why not think of that as a more politically saleable way of implementing the optimal policy?
Well, what are you going to subsidize?
Everything but carbon. Well, you can subsidize electric vehicles. You can subsidize renewable power, nuclear power, any number of things.
Yeah, I just don't know what to subsidize. I don't think anyone knows, right? And that's why I would say price the externality rather than subsidize.
So you're saying you couldn't implement this through?
Now, normally, here's the problem. In most of the economic models, what we want to capture is what would happen if you put in some new policy in terms of new technologies, new innovations, and things like that you don't know about. And so trying to describe that, even conceptually, let alone in actual legislation, that says, if you come up with some technology which in our assessment will reduce the amount of carbon in the air by 1 ton, we'll give you this bundle of money. is a really hard conceptual problem. If you think you know exactly what the range of alternative technologies are, in those kinds of environments, in those kinds of models, you get the standard result that a tax on the externality, a subsidy on the alternative, since only the relative price matters, are exactly equivalent.
So it's the fact that that we don't know the span of technology.
That we don't know how to describe the span of technologies. And like in the SO2 example and in others, it's very hard for economists to describe it, though we can see it in practice.
And also the political economy, I would just say, there's all kinds of issues. So for example, there's a tax subsidy called 45Q, which some of you may have heard about, which is a funny coalition between environmentalists on the one hand and oil companies on the other, where the government will subsidize any operation that pulls CO2 out of the atmosphere and sequesters it permanently. And so, as you may know, where carbon dioxide is actually used in industrial processes now is in oil drilling. And so you've got the oil drillers who are getting a subsidy by taking CO2 from the cheapest producers of CO2. Actually, right now, the cheapest CO2 comes from mining, but the subsidy here only is if it would otherwise go into the atmosphere. So the cheapest source of CO2 that goes into the atmosphere is these ethanol plants. So this would be, and then if you look at what this accomplishes, I mean, the amount of CO2 is tiny, the cost is huge, and so I just worry about, those kinds of.
Let's take last question from Randy.
Yeah, that's fascinating stuff. I wonder how you operationalize some of it. So you mentioned that if the temperature goes up by 2 degrees, you're going to lose 99% of the coral reefs. As a romantic, it sounds like a disaster. As an economist, I say, what's that worth in dollars? How do you get the dollar value of these things?
Yeah, I mean, I just use that as an example because it's one of the more dramatic differences that we see now. I wouldn't underestimate the economic impact of coral reefs because they're kind of at the bottom of the food chain of the ocean, and healthy oceans are probably important to well-being and so on. But your point is a good one. When we try and say what are going to be the damages of a 2-degree world, who knows? And and again, I don't think we'll get to a 2-degree world because we'll figure out that the least expensive way to address this is in part cooling down the planet. And we will probably figure out ways to address acidification and some of the other things. But it's not clear that this is easy to address through adaptation. Look at what's going on with the forests around the world now. The forest fires are just growing exponentially throughout the planet, and that leads to positive feedback because obviously those burning forests are putting more CO2 into the atmosphere. And it's not easy to put out the forest fires in Indonesia, in the Amazon, in the tundra now. We're seeing forest fires in above the Arctic Circle that you could never imagine before. Plus, the tundra itself is melting, and that releases methane. So I would just call it a lot of risk associated with heating up the planet. And just in this week's Scientific American, there's an article by some very distinguished scientists talking about the fact that things look to be getting much worse, much faster than they had expected. And why is that? Because science should be unbiased. But there are kind of built-in biases in science to projecting out of sample that suggests that things could actually be much worse. And so it's the more you learn about this, I would say it's a pretty scary scenario, and you have to say to yourself, why are we doing this? And the issue is not should we be pricing this, it's where should we be pricing it. And now I'm very optimistic, more than most, that we are going to get a federal carbon tax in this country in the next 2 or 3 years, and probably globally very shortly after that, because it's widely recognized that this is a very serious problem. I tell people this Climate Leadership Council that I sit on, we have what we call founding members. and that includes ExxonMobil, Shell, BP, Total. On one hand, it includes the Nature Conservancy, World Wildlife Fund. On the other, we've got GM, Unilever, J&J. We've basically got all of the largest corporations in the world and the environmentalists. And there's not very many people outside of that coalition. You might ask, who is outside of that coalition? And right now,
One person in particular is outside.
but you know, and we've been working on Capitol Hill. We have a C4, which is a lobbying operation. It's been funded by the oil companies, and we're out there lobbying Republicans. It's really Republicans in the Senate. If you want to know who the big problem is right now, it's not even the president. It's Mitch McConnell. And he won't bring it in front of the Senate. And as long as he's not going to bring it in front of the Senate, the Republicans in the Senate aren't going to talk about it. And they're not going to, you know, beat their head against the wall. They all understand it. And I would say, so we've been focusing particularly on Mitt Romney. And, you know, he actually just 3 days ago gave a speech where he supported this carbon dividend plan. So there's about 5 Republicans who've already said they're in favor of pricing emissions, and there's probably another 15 who, in the privacy of their own office, would say, look, if it comes up, I'll vote for it. So that's where we're at. We're at a tipping point where this is going to happen. It's not clear when or how, but you know, I think we're in pretty good shape in that sense. I don't think it's going to go on that much longer.
So 5 years ago, Bob and I co-organized a conference under the auspices of Heller Hurwitz at the University of Minnesota. The papers were just extraordinary. A subset of those papers will, we hope, soon be published by John Wiley. If you want a small foretaste of what's in those papers, there's a Minneapolis Fed staff report that I authored, which is readily accessible, which sort of tries to describe what those papers are about and tries to give you the settings. So I want you to join me. You know, what Bob presented is what I think of as the best of Minnesota economics. It's built on theory as close to the frontier as we can get it. It's serious quantitative analysis, attempting to put numbers on important things. It has passion behind it, as you saw from Bob's remarks. And at the end of the day, it has unwarranted optimism. That makes Minnesota economics special, because we think the future is going to be great, and I think the future for this partnership is extraordinary. Thanks to all the people who created the partnership. So let's thank Bob on that note.